Last week, I was standing at a currency exchange window at Incheon Airport watching a woman nearly collapse into tears. She was staring at the digital board where the Korean won was plummeting, hitting depths that felt like a national emergency. "We're becoming a third world country," she muttered, frantically counting a stack of bills that seemed to be losing value even as she held them. To her, those flickering red numbers were an obituary for the nation. But just an hour later, I pulled up the market data for the very same country, and the picture was unrecognizable. The KOSPI index wasn't just growing, it was on a historic 75% tear, screaming toward the heavens. It was a total sensory mismatch. It was like watching a man's pulse flatline on a monitor while he simultaneously wins an Olympic sprint. The world's financial elite call this the Korea discount, a supposedly logical reaction to political drama and currency instability. But as I looked at the silent, windowless monoliths of the semiconductor fabs in Pyeongtaek, I realized the discount is a hallucination. It's a bias held by a financial class that has forgotten how to value anything it can't print on a ledger. What we are witnessing in 2025 isn't an economic crisis. It's a brutal, preemptive divorce. It is the moment the industrial soul of a nation finally severs itself from its financial body. While currency traders panic over paper claims, the engineers in Incheon are etching a new form of hard-tech hegemony onto 3-nanometer wafers, a power so absolute that traditional exchange rates are becoming irrelevant noise. Why is the global market treating Korea like a failing state, even as Korea builds the physical substrate of the AI era? The answer lies in a fundamental reordering of power, where the hum of a clean room carries more weight than the decree of a central bank. To understand the future, we have to stop looking at the money and start looking at the machines.
That opening story is, well, it's just perfect. That visceral human reaction at the airport versus the cold, hard market data, it really captures the core puzzle we need to unpack in this deep dive.
It felt like two different realities.
Exactly. And your metaphor, the brutal, preemptive divorce, is so accurate. It's profound, really. For decades, you could look at a country's currency, especially an export-heavy one like Korea, and it would tell you pretty much everything you needed to know about its financial health.
They were locked together.
Completely. Two sides of the same coin. But something has fundamentally snapped in 2025. That link is broken. The underlying reality, the sheer physical necessity of what Korea builds, its hard-tech output, is so powerful now that those old metrics, like the daily $1 rate that poor woman was watching,
they're just noise.
They're becoming irrelevant noise. It's a distraction for people, still using a 20th century playbook.
Right.
So our mission today is to figure out exactly how that industrial soul pulled off this divorce from the financial body, and what that tells us about this new world economy we're entering, one that's really built on computing power.
Okay, so let's start with the numbers because they're just wild. They tell a story that completely contradicts the panic at the currency exchange. If you look at the market performance this year, just through September 30th of 2025, the MSCI Korea Index is up a staggering 48%.
48%. It's an incredible figure.
It's not just a good year. That number makes it the strongest performing major index in all of Asia. It's beating everyone. So when you see a rally like that, your first thought is, okay, one of two things is happening. Either the government pulled off some policy miracle or we're in a completely irrational bubble.
And the initial instinct for most analysts was to point to policy. You can't blame them, really. The political momentum was huge. You had the new administration making this very loud, very bold pledge.
The KOSPI 5000 promise.
Exactly. KOSPI 5000. It wasn't just a soundbite either. They packaged it with a whole framework, the Value Up Initiative. And on paper, it was aimed squarely at that old problem, the Korea discount.
Right. The idea that Korean companies are always undervalued because of governance issues, the K-balls, all of that.
All of it. So Value Up was designed to tighten the rules, force better returns for shareholders, and restore some of that investor confidence after a really rocky period. And to be fair, those actions did act as a catalyst, a necessary one. They got global investors to look at Korea again.
But a catalyst is one thing. It gets the fire started. It doesn't keep it burning that hot for that long. I remember when Value Up was announced, there was a lot of skepticism. People were asking, are investors buying the government's talk or are they seeing something else? Because policy moves slow and a 48% rally happens. Well, it happens fast.
That is the absolute core of it. That's the friction point. We have to peel back the layers here. You have to separate the government's rhetoric, its promises, from the country's actual innate industrial power.
Okay.
Because the real foundation of this rally, the thing sustaining it, it's rooted less in the promise of regulatory tweaks and more in these profound, almost irreplaceable structural strengths. We're talking about advanced technology, AI infrastructure, and these new resilient supply chains for energy and defense.
So the governance reforms were the excuse the market needed.
That's a great way to put it. They gave the market a reason to pay attention. They were the much-needed push. But the actual fuel for that 48% tear, it was already there, built into the industrial base, just waiting for a spark to ignite it.
Which brings us, inevitably, to the giant elephant in every Korean boardroom. The cables,
Right.
the family-controlled conglomerates. The government can talk about reform all day, but historically these groups have fought tooth and nail against anything that weakens their control or forces them to give more back to minority shareholders.
Right.
So is it fair to say that the market's optimism about value up might be, let's say, getting a little ahead of the actual on-the-ground changes?
Oh, that's more than fair. It's critical to understand the limitations here. That KOSPI 5,000 target is incredibly ambitious. And trying to get there just through governance reform means you have to undo decades of a very deeply entrenched corporate culture. The hardest part is getting the interests of those founding families to line up with the interests of, a pension fund in California or just regular Korean retail investors.
It's a structural conflict.
It is. It's not just political. And it's why progress is so slow.
So let's get specific. When we say governance reform, it sounds a bit abstract for a market that's gone vertical. What are the really painful changes that are still stuck in the pipeline?
Okay, so it really boils down to two main things that hit the cables where they live: tax changes and something called treasury shares.
Treasury shares. Explain that.
So many of these huge companies hold massive blocks of their own stock treasury shares that they bought back over the years, often pretty cheaply. The problem is they can use these shares for things like mergers or paying executives, which ends up suppressing the stock price and diluting the value for everyone else.
So what do investors want?
Investors want the government to force them to cancel the shares. Just take them off the books entirely. That would instantly boost earnings per share for everyone who remains, and it would be a huge signal that they're serious about shareholder value.
But the companies don't want to do that.
Of course not.
Yeah.
It's a powerful tool for them to maintain control. So without a government mandate, they have very little reason to just give it up.
And the second piece was taxes. I've heard trying to predict Korean tax policy is difficult.
It's notoriously volatile. That's the other big hurdle. The government has to thread this needle. They need to create tax incentives for the cables to pay out more dividends and unlock value, but they can't be seen by the public as just giving tax breaks to the country's richest families.
It's a political minefield.
A huge one.
Yeah.
And it requires really surgical changes to the tax code. But right now, the investment community sees it as completely unpredictable. There's this saying going around that trying to forecast Korean tax policy is like reading tea leaves in a storm. You can't make a 10-year investment plan based on that. So the market isn't betting on the reforms being done. It's betting on the tech strength, in spite of the slow progress on governance. If KOSPI hits 5,000, it'll be because the engineers dragged it there, not because the regulators pushed it, at least not yet.
That distinction, catalyst versus engine, is so important. If the value-up plan was a catalyst, let's pop the hood and look at the engine. You said some sectors delivered almost 70% of that massive 48% gain. Where did that power actually come from?
The data here it's just so clear. It confirms this whole hard tech thesis completely. When you break down the MSCI Korea Index performance for this year through September, it's dominated by two areas: technology, obviously, and what you'd call security-linked industrial sector.
So defense, things like that.
Exactly. And combined, those two areas account for nearly 70% of the total return. Just think about that for a second. That level of concentration is incredible.
70%. Which means all those other sectors that were supposed to benefit from the value up initiative, the banks, the utilities, the undervalued old economy stocks, they only contribute about 30% of the total gain.
Right.
This basically disproves the idea that the rally was about a broad re-rating of the entire Korean market because of better governance.
It completely refutes it. It shows the rally is highly thematic, it's targeted, it's being driven by these powerful, and this is the key geopolitically essential tailwinds. The market is placing a massive premium on unique, irreplaceable industrial power.
And there's no better example of that than what you call the HBM anchor.
The HBM anchor. This is really where you see that industrial soul beginning to detach itself from the financial body. It's happening because Korea is building the literal physical infrastructure for the entire global AI revolution.
HBM, high bandwidth memory. For anyone who might have heard the term but isn't deep in the tech, explain why this isn't just the normal memory you have in your laptop.
Oh, it's a different universe. This isn't just RAM. HBM is this incredibly complex stacked memory that has to sit right next to the main processor, the GPU, in these massive AI servers. It's what allows the AI to access huge amounts of data at lightning speed.
And why is Korea so dominant in making it?
Because it is brutally difficult to manufacture. You're not just making chips, you're stacking them vertically, like a tiny skyscraper, and then drilling microscopic tunnels called PSVs through all the layers to connect them.
Sounds complex.
The failure rates are insane. The heat it generates is a massive problem. Honestly, only a handful of companies on the entire planet have figured out how to do this reliably, and at the scale the world now demands.
And those companies are?
Samsung Electronics and SK Hynix. They are the absolute bedrock of this entire global pivot to AI. Between the two of them, they control over 80% of the global market for HBM. This isn't a commodity business where you can have 10 competitors. This is a highly specialized strategic chokehold. Every single major tech company in the world, whether they're in Silicon Valley or Shanghai, if they want to build a large language model or run an AI data center, they are desperately dependent on these two Korean companies.
That kind of market concentration is just mind-boggling for something so critical. But let's connect that back to the market rally. How much of that 48% KOSPI gain came from just those two giants?
This is the number that just stops you in your tracks. They contributed approximately 40% of the total index gains this year.
Wow.
Let that sink in. 40%. Two companies making one very specific, absolutely essential physical product. They account for 2/5 of their country's entire market boom. That is the definition of hard tech hegemony.
It's a supply chain choke point.
It is. They have built an unassailable position in the AI hardware value chain. Their lead is based on decades of quiet, grinding R&D and specialized engineering talent. It creates a moat that competitors can't cross quickly, no matter how many billions of dollars they throw at the problem.
So, going back to our opening paradox, if the Korean won drops 10%, but the world remains 80% dependent on your country for the one component it needs to power its multi-trillion-dollar AI ambitions, which number is the rational market going to care about more?
Exactly. It explains the entire disconnect.
The financial world is stuck looking at paper claims, at currency risk.
They see a risk premium on a currency. But the person building an AI server farm sees an irreplaceable supplier. They're valuing two completely different things.
Right.
One is valuing the ability to pay a debt in dollars today. The other is valuing the ability to control the future of computing for the next decade.
That 40% contribution from just two chip makers is the proof. It's the smoking gun for this industrial power thesis. So now let's zoom out a bit and look at the geopolitical stage, because this isn't happening in a vacuum.
Not at all.
Exports are everything for Korea. It's something like 44% of the country's GDP. That makes the economy incredibly sensitive to global shifts, especially this huge rivalry between the US and China. But what the data is showing is that Korea isn't just a passive victim here, it's actively strategically pivoting.
It is, and this pivot in its trade geography over the last 5 years is probably one of the most important and most underreported stories of its resilience. The numbers couldn't be clearer. You can see a very deliberate shift in its strategic alignment.
Away from China.
A huge move away from China. China used to be the #1 destination for Korean exports. It was about 26% of their total. That has now fallen all the way down to 18%.
That's a massive shift for a trade relationship that big. So where is all that output going instead?
It's heading west, overwhelmingly. In that same period, exports bound for the United States have shot up from 14% to 18%.
So they're now equal partners.
Exactly equal. This is not a random fluctuation. It's a conscious strategic realignment. Korea is positioning itself squarely inside the new supply chain reality being built by the US and Europe. As this whole de-risking from China accelerates, Korea is emerging as one of the very few, very critical winners.
Okay, but why Korea specifically? When companies want to diversify away from China, why not just move production back home to the States or to, say, Vietnam or Mexico? What makes Korea the natural substitute?
It really comes down to two things: trust and capability. You can move low-end manufacturing anywhere, but Korea's strengths are in high-end, complex, technology-advanced machinery, specialty chemicals, and of course, semiconductors.
Things you can't just set up a factory for overnight.
Exactly. And that's coupled with the fact that they are seen as a reliable, politically aligned partner. So global companies need to de-risk their supply chains, but they can't sacrifice quality or technological sophistication to do it. Moving production to a lot of other places means taking a step backward technologically. Moving it to Korea means you get advanced manufacturing and geopolitical reliability.
Can you give us a concrete example of this, beyond just the chips? Where else is this trust factor creating a real advantage?
Look at defense and new energy. These are two huge growth areas. Korea is rapidly becoming a key security partner for countries, especially in Europe, that are worried about regional stability. The quality and reliability of their defense hardware is world-class.
And the nuclear energy sector,
which we'll get into more detail on later, yes.
Yeah.
But the technological sophistication there is another asset that can't be easily copied. So while China is fighting a price war at the low to mid end of the market, Korea Inc. is solidifying its position in these high barrier sectors, advanced tech and industries built on national security and trust. And that structural strength is what the market is finally valuing more than short-term currency jitters.
This idea of being a trusted national partner, not just a supplier, leads us right into this concept of sovereign AI. The term is everywhere now in strategy meetings, but I think we need to define it properly. What does sovereign AI actually mean, and how does Korea fit into this massive emerging trend?
At its simplest, sovereign AI is a country's ability to develop and deploy artificial intelligence on its own terms, independently.
So without relying on a foreign tech giant.
Exactly. To be truly sovereign, you have to control your own technology stack. That means your own infrastructure, your data centers, your supercomputers. It means your own curated pools of data, your own foundational models trained on your own language and culture, and critically, your own local talent.
And the goal is
Where?
to be completely self-sufficient and cut off from the world.
Not at all. The goal is to innovate and grow, but to do so while keeping full control over the whole AI lifecycle. You do it to guarantee data privacy for your citizens, to make sure the AI aligns with your national ethics, and to free yourself from the risk of foreign dependency.
It sounds like digital independence, but why is this huge global push happening right now? Is it just about the fear of a US-China tech war?
That's a huge driver, but it's two things, really. Geopolitical risk and the value of data.
Yeah.
Think about it. If you're a European government and you're using a foundational AI model developed in another country, you are fundamentally trusting the country's hardware, its laws, and its political whims.
Which is fine for some things, but not for others.
Exactly.
Yeah.
If you're talking about your national healthcare database or a bank's secret trading algorithms, that level of reliance becomes an unacceptable risk. The moment you saw figures like NVIDIA's CEO, Jensen Huang, flying to places like Denmark to personally turn on their first national AI supercomputer, that's when you knew the global race was on. It's now a pillar of national strategy, and it's a CEO and board-level issue for every major company.
And this risk assessment is creating what looks like a multi-trillion-dollar market opportunity. Give us some sense of the scale of the money that's about to be spent on building all this sovereign infrastructure.
The demand is. It's just colossal. Analysts are still trying to get their arms around it, but the early estimates are mind-blowing, and it's all being driven by this need to mitigate geopolitical risk. The global market potential for sovereign AI infrastructure is currently pegged at about $1.5 trillion.
$1.5 trillion.
And if you zoom in on just one region, say Europe, which is obsessed with GDPR and digital rights, the opportunity just for them to build out compliant sovereign AI systems is estimated at $120 billion.
That European number is really telling. It shows that even a place that's all about economic integration is now prioritizing national or at least regional control over just using the cheapest global provider. What's the global sentiment look like?
It's overwhelmingly driven by that uncertainty. There was a huge survey of almost 2,000 leaders, business and government, across 28 countries. It found that 61% of them are now actively seeking out sovereign tech solutions, specifically because of rising geopolitical risk.
And that's turning into actual policy, right?
Directly. The forecasts suggest that by 2028, something like 65% of governments around the world will have put new rules in place to enforce technological sovereignty and protect their independence.
And we're already seeing this happen in real time. Can you give a few examples of countries that are really pushing this hard?
Absolutely. This isn't a theory anymore. Look at Switzerland. They're famous for their data privacy laws, right? They're launching their own compliant cloud services to make sure that sensitive banking and health data never, ever leaves Swiss jurisdiction under the control of a foreign company.
Right.
Then you have India, which has announced this huge sovereign AI plan. They want to build their own models that are tailored to their hundreds of languages and dialects. Or the Humane Initiative in Saudi Arabia, which is baking tech sovereignty right into their national economic plan.
So Switzerland, India, Saudi Arabia, they're all seeing this as a strategic imperative now.
They're moving way beyond just reacting to regulations. They're building sovereignty into their national growth plans. And for a country like Korea, the key realization is this. If you're the world's primary source of HBM, you are selling the foundational bricks and mortar for this entire $1.5 trillion global construction project.
This feels like a massive shift in mindset. For years, the idea of sovereignty in technology was defensive. It was about building firewalls, checking compliance boxes, mitigating risk.
Exactly.
But now it seems like the leading nations and companies are treating tech independence as an offensive weapon, as a strategic asset. How do you turn a compliance headache into a competitive advantage?
It's a complete reframing of what value means. The old drivers were all about defense, like you said. Compliance, risk management, making sure your data residency satisfied the lawyers. But the smartest firms are realizing sovereignty is a source of value creation. They're moving past just being compliant and are now using local trust and cultural alignment as a real monetizable advantage.
So this is about more than just translating the user interface into the local language. You're talking about embedding the entire national context into the AI itself.
Precisely. A sovereign AI can reflect local language nuances, unique cultural values, even specific historical contexts. Take language models. A model trained mostly on American and European data is going to struggle with the complexities of, say, Korean hierarchical social structures or its regional dialects.
It won't get the nuance.
It won't. So sovereign AI turns artificial intelligence from something foreign that's sort of imposed on you by a global tech giant into something that's built for you, for your nation, your people. And that cultural alignment is huge. It makes citizens trust the technology, it ensures local businesses capture more of the economic value, and it gives you clear legal recourse when an algorithm gets something wrong. It's basically a form of nation building with technology.
That makes total sense for building consumer trust, but how does that create a hard business advantage, especially in really regulated industries? Doesn't walling things off slow down innovation?
You'd think so, but it can actually accelerate it, as long as it's within a trusted environment. That's the power of building ecosystems. Sovereign AI platforms let companies within a closed, trusted group, whether that's a whole country, an industry, or a supply chain, securely share data and insights that they would never, ever share on a global platform.
That's a huge deal for finance or healthcare.
Revolutionary.
Okay, give me a real-world scenario. How does that data sharing actually work in a sovereign ecosystem?
Okay, imagine you have a few major Korean biotech firms. They're all trying to develop a new cancer drug. They all have incredibly valuable proprietary patient data from clinical trials,
which they would never share with each other.
And they certainly can't just upload it all to a global cloud and let some generic AI model run on it. The compliance and competitive risks are just too high. But inside a sovereign, trusted platform built on Korean infrastructure and governed by Korean law, they can start to collaborate. They can build shared AI models, share anonymized insights from their data, and speed up R&D for everyone without fearing that their secrets will leak or they'll get hit with a compliance violation.
So it creates these little sandboxes for innovation.
Exactly. It fosters these secure data marketplaces. And you see the leading firms now investing heavily in what they call ecosystem readiness, helping their partners and suppliers get onto these sovereign platforms. It flips the model. What used to be a cost center for compliance becomes an engine for national innovation.
Okay, so this shift from defense to offense, from compliance to strategy, it requires a completely new way of thinking from leaders. For anyone listening who's running a global business, what are the actual practical steps you need to take to do this right? What's the difference between the companies that win in this new era and the ones that just get swamped by regulations?
There are really 4 non-negotiable imperatives, and they have to start right at the top of the company. First, you have to make sovereignty a CEO-led priority.
It can't be delegated to the IT department.
Absolutely not. Or the compliance team. Geopolitical risk is now an enterprise resilience issue. It's a growth strategy issue. When the CEO owns it, the entire AI strategy gets aligned with the long-term reality of the business.
Okay, that's number 1. What's 2?
Second, leaders have to consciously reframe sovereignty as a source of value creation, just like we were saying. You have to get out of that defensive crouch. It means actively looking for ways to use localized data, tailor your AI to fit specific cultural contexts, and use that to build deeper customer trust.
That sounds expensive, though. Does this mean you have to build your own private data center in every single country you operate in?
That's a great question. And it leads to the third imperative, which is building hybrid ecosystems. This is the practical answer. You don't have to become a technological hermit. The key is to combine that local trust, which you need for your most sensitive data, with the scale and innovation you get from global platforms for everything else.
So you separate your workloads.
You have to. And the research on this is really interesting. It suggests that for most organizations, only about 1/3 of their AI workloads actually need to be fully sovereign.
Only a third. That's a game changer.
It is. It means you could be strategically sovereign where it counts, on your crown jewels, without cutting yourself off from the best global tech for the other 2/3 of your business. It's a balanced approach.
And the fourth imperative for leaders.
The fourth is to architect your entire AI stack for flexibility. You have to build in adaptability at every layer. The infrastructure, the data, and the models themselves. This means you have to move past a static, check-the-box approach to compliance and get to a state of predictive sovereignty.
Predictive sovereignty, what does that mean?
It means you need real-time, continuous auditing of your whole system, from the physical hardware and its power source all the way up to the cloud services and the AI models. You need to be able to detect dependencies before they become a political or economic problem. You need to be predicting the next move on the geopolitical chessboard, not just reacting to the last one.
Let's drill down on those layers for a second. You said the audit needs to cover hardware, data, and models. Where are companies feeling the most pressure right now? Which layer are these new sovereignty rules targeting the most?
Well, no surprise here, it's the data layer, by far. About 60% of the organizations we've seen are applying sovereignty or residency rules directly to their data. Everyone understands that the raw information is the most sensitive asset.
And what's number two after data?
The next is the infrastructure and cloud layer. That's at 36%, which also makes sense, right? Your data residency rules depend entirely on where the physical servers are located.
And the AI models themselves are further down the list.
Right. They're only at about 22%.
Right.
Because if you control the data that goes in and the infrastructure it runs on, you have a pretty good handle on what comes out. But the ultimate goal, as we said, is to make this predictive. To have a system that flags a warning when, say, a software patch comes from a sanctioned country or a cloud provider changes its terms of service about data jurisdiction, that proactive stance is how you secure your future.
We've laid out this whole case that the KOSPI is flying high because of this hard tech dominance, the HBM chips, the sovereign AI strategy, but none of that works. The multi-billion-dollar clean rooms, the 3-nanometer wafers, none of it exists without massive, constant, and this is the critical part, cheap energy. This brings us to the foundation of it all. The physical, humming reality of Korea's industrial power. It's energy sovereignty. We love talking about the clean room, but we never talk about the actual power plant that keeps the lights on 24/7.
You just can't overstate how vital stable power is to this whole equation. A semiconductor fab is probably the single most capital-intensive factory you can build on Earth. And it's what's called a baseload facility. It never shuts down.
Never.
Any flicker in the power supply, any spike in the cost of electricity feeds directly into the risk and the cost of making the nation's most valuable product. If the power goes out for 5 minutes, you might have to throw away $1 million worth of product.
So if your electricity is expensive or unreliable, your whole HBM industry is dead in the water, no matter how good your tech is or how strong your currency is. So how has Korea solved this? What's their edge over Japan or the US, who also have high-tech manufacturing?
Their edge comes from a decades-long, unwavering commitment to nuclear power as their main source of this reliable baseload energy. And you can see this advantage so clearly when you look at the hard data on construction costs. We can compare their standardized, pressurized water reactors, the KORN-1 and KORN-2 models.
Okay, you mentioned some technical numbers in the source material. You used metric dollars per kilowatt electric or to kilowatt aways. Bring that down for us. What does that actually mean in practical terms?
It's the specific overnight construction cost. So think of it as the sticker price for every single unit of electricity generating capacity you buy before you add in any financing costs. It's the global benchmark for comparing how efficiently different countries can build these huge long-term power assets.
So a lower number is better.
A lower number is a massive long-term competitive advantage. It means you get more energy security for every dollar you invest, which leads to cheaper electricity for the entire 60-year life of the plant.
Okay, so with that context, hit us with the comparison numbers again.
The overnight construction cost for Korea's KORN-1 was an incredibly low $1,208 per kilowatt electric. For KORN-2, because they'd standardized the design, it was even cheaper at $1,074.
And how does that compare to their competitors?
The contrast is just stark. In Japan, the retorted cost for similar capacity was more than double Korea's, at $2,510 per kilowatt electric. Even in the United States, it was way higher at $1,894.
Wait, hold on. If Japan is paying more than twice what Korea pays to build the same amount of nuclear power, that's basically a guarantee that Korean chip fabs will have energy costs that are potentially half of what their Japanese rivals pay for the next 50 to 60 years.
That's it. You just described their physical advantage. It's an industrial subsidy that's literally built out of concrete and steel into the national infrastructure. Their standardized designs, their efficient supply chain, their skilled workforce. It all lets them build these stable power sources at a huge discount to the rest of the world. And that means stable, low-cost power for their most important industries, no matter what the one or the global gas market is doing.
And this cost advantage isn't just about the initial construction, is it? It also impacts the ongoing operational costs.
It does, and this is another piece that adds to their stability. The way Korean nuclear power is structured, their operating costs, their O&M uniquely include things that other countries often kick down the road for future taxpayers to deal with.
Like what?
The price of decommissioning the plant when it's old, the cost of treating spent fuel, and managing radioactive waste. It's all baked into the cost structure from day one. This gives industrial planners incredible long-term certainty. If you're building a new fab in Pyeongtaek, you know your power costs are shielded from some future political fight over waste disposal. This deep infrastructural control is a massive tangible asset that a volatile currency exchange rate just can't measure.
The word you used, shielded, is perfect. This whole conversation started with that sensory mismatch, right? The financial body is sick, but the industrial soul is thriving. This nuclear strategy feels like the physical shield that allows the industrial soul to do that. It's almost like a financial hedge, but a physical one.
The physical hedge analogy is the perfect way to tie this all together. Let's start small, at the company level. In a liberalized energy market, a big factory might install its own generator on-site, right?
Okay, for backup.
It's more than backup. That generator acts as a physical hedge against price volatility. If the market price for electricity suddenly spikes because of a heat wave or a gas pipeline problem, the factory just flips a switch and starts making its own cheap power. It has a physical cap on its energy costs. It's hedged.
And you're saying Korea has done that, but for the entire nation?
Exactly. Just scale that same logic up. A country that builds out a massive fleet of low-cost, predictable baseload power for Korea, that's their nuclear plants, is fundamentally insulating its most critical industries, those HBM fabs, from the wild swings in global commodity prices. The cost to run their reactors is mostly fixed. It's not tied to the spot price of an LNG tanker arriving from Qatar.
So while a competitor in, say, Germany might see their factory's energy bill double because of a political crisis somewhere, the Korean semiconductor giant's energy cost just stays flat and low.
Precisely. By locking in these stable, cheap energy inputs, Korea has created a national industrial hedge. It guarantees that the core production cost of their globally essential technology remains predictable and competitive no matter what currency traders are doing in the foreign exchange market or what geopolitical shock is happening to fuel supplies. It's the ultimate physical guarantee of industrial survival.
It's a source of value that financial models just aren't built to see.
They are structurally incapable of valuing it because it's a story cold in physics, not finance. The value is being etched onto silicon, and it's being powered by the atom.
It's the perfect explanation for the paradox we started with. The financial body is getting battered by sentiment and paper volatility, but the industrial soul has built this huge physical shield to protect itself. It really proves that in this new AI era, real power is about the physical ability to build and sustain technology, not about paper valuations.
If we synthesize everything we've discussed, the market's focus on HBM, the geopolitical trade pivot toward the US, the strategic imperative of sovereign AI, and the physical security provided by nuclear power, the conclusion is unavoidable. The fundamental reordering of power is complete. We have moved decisively past a reliance on monetary exchange rates as the primary barometer of national health or wealth. Today, the most crucial indicator of national resilience and industrial survival is computing power sovereignty, underpinned by affordable, reliable energy infrastructure. Korea's strength is not found in the paper claims of its volatile currency, but in the physical assets. The capacity to manufacture 80% of the world's critical AI memory and the low-cost nuclear power plants that guarantee those fabs never stop humming.
So what the financial world continues to call the Korea discount isn't an economic reality. It is, quite simply, a financial class hallucination. It is the stubborn bias held by those still gazing solely at paper claims currency ledgers, quarterly reports focused on governance reform rhetoric, while the true, tangible power is being established in the physical substrate of the AI era, etched onto those 3-nanometer wafers. The deep dive shows us this. The future of national wealth belongs to those who control the entire technology stack, from the baseload energy powering the facility to the proprietary data models it runs. The future belongs to those who build their technology stack sovereign.